Money. It's something that we use every single day, yet most people have no idea where it truly came from, how it's changed, or even where it's headed next. We've come from bartering cows and grain between two farmers to trading gold and silver coins between early modern empires, and now we're trading paper bills and digital numbers on a screen that can literally be printed out of thin air. The point I'm trying to make is that money has evolved to match the needs of society. But here's the truth, this evolution didn't stop with the dollar. No, it was leading us towards something way bigger. And this something bigger, of course, is Bitcoin. It wasn't some lucky invention or a random idea cooked up on the internet, even though that's what a lot of people think. It was the inevitable next step in the story of money and an unavoidable innovation born out of centuries of trial and error and accelerated by failures of our modern financial system. In this video, we're going to trace that journey, uncover why Bitcoin had to happen, and show how it's reshaping the global economy today. So firstly, what is money? Well, at its core, it's a financial tool. It's a shared agreement between people that something has value, can be exchanged, and can serve as a way to measure worth. But it wasn't always this clean and efficient. Let's go back thousands of years before paper, bills, and coins rocked the entire global economy. What do humans rely on? They relied on the barter system or the trading of goods and services directly between one another. You might trade a cow for a sack of grain or a fish in exchange for some tools, but this system had obvious flaws. What if the other person didn't have what you wanted? Or what if you only needed half a cow's worth of bread? You can't exactly cut a cow in half and store the other half for yourself for a long period of time. There were obvious inefficiencies and limitations, and over time, societies began shifting towards commodity based money and then eventually money backed by the government. So, over the last few hundred years, humans have tried three main types of money. This includes gold, fiat, and now digital currencies, which are emerging across the global economy. Gold is the oldest form of money, and you probably know this. Why? Well, it's scarce, it can't be easily created, and it holds intrinsic value. Civilizations all over the world have used it for thousands of years, but there is a problem. Gold isn't a form of money that we would call portable. I mean, it's heavy, it's hard to divide, and nowadays it's completely impractical to use in our fast paced digital world. I mean, trying paying for groceries with gold or transferring gold across borders, it just doesn't work, and most businesses won't accept it as a form of payment due to how inefficient it is. After this, we saw the rise of fiat currencies like the US dollar. These are government issued and easy to use, and they're accepted almost everywhere, and they're fully digital in most economies we see today. But there is a catch. The dollars aren't scarce. I mean, governments can print fiat at any time they wish, and there's a common myth out there that governments earn their money through trade, which is true to a degree, but it isn't the driving cause of how they make money. And in reality, most of the money we see in our economy today is printed out of thin air. This unchecked printing leads to inflation, which we'll dive into deeper later in this video. But for now, understand this. Fiat only works because people trust the institutions and entities that create it. Enter digital currencies like Bitcoin, designed to merge the best traits of both previous systems. Like gold, Bitcoin is limited in supply. Only 21 million will ever exist. Ever. But unlike gold, it's digital, it's easily portable, it's divisible down to 8 decimal places known as sats, and can be instantly transferred across the globe. It's also programmable, meaning that you can build new tools and systems on top of it. Bitcoin doesn't rely on trust in governments or banks. It relies on trust in math, in code, and consensus. We'll dig into why that matters in just a moment. But before we do that, let's uncover the trust problem and what happened in 2008 that really lost a lot of interest and backing by the people around fiat. So the modern financial system is built on one thing, and that is trust. Trust in banks to safeguard your money. Trust in governments to manage the economy. Trust in institutions to act responsibly. But in 2008, all this trust was shattered. For years leading up to this major crash, major banks have been handing out high risk mortgages, loans to people who couldn't afford them. These risky mortgages were then bundled into complex financial products called mortgage backed securities, and on the surface, they look safe and perfectly fine. I mean, rating agencies even stamped them with top ratings. Investors bought in thinking they were low risk and high reward, but when the housing bubble burst, those financial products collapsed almost overnight. Suddenly, banks were holding billions upon billions in toxic debt. And one of the most iconic collapses was the Lehman Brothers, a massive investment bank that filed for the largest bankruptcy in US history. I mean, panic spread, credit markets froze, people lost their homes, small businesses were completely wiped out, and retirement funds evaporated out of thin air. And how did the governments respond? Well, they used taxpayer money to bail out the very financial institutions that caused this crisis. While everyday people like you and me faced job losses and foreclosures, these banks, deemed too big to fail, were rescued with hundreds of billions in emergency funds, while we had to sit here and watch and endure all the pain. This wasn't a natural disaster, nor was it a war. It was the result of greed, recklessness, and a financial system that had no accountability. And for many, it exposed a dark truth: that the system was broken and rigged to protect those on top. Now, this crisis brings us to a very memorable innovation in technological and the financial industries. In 2009, an anonymous figure or group going by the name Satoshi Nakamoto released a new kind of money, at least what it was proposed for at that time. And this was Bitcoin. It was promised to be a decentralized peer-to-peer digital currency with no banks, no bailouts, and no CEOs. Just a code-based system where rules replace rulers and every participant plays by the same transparent protocol. And Bitcoin's launch wasn't subtle. Embedded in the very first block of the Bitcoin blockchain was a message and a warning. The Times, the 3rd of Jan 2009, Chancellor on brink of second bailout for banks. And this was a statement made by Satoshi Nakamoto. And Bitcoin was created in a direct response to a broken financial system. A system where bad decisions were rewarded with taxpayer money, and ordinary people like you and me had to pay the price. But Bitcoin isn't just a protest coin. It's a functional upgrade to many of the systems we rely on today. For starters, it has a finite supply. Only 21 million coins will ever exist. That makes it incredibly scarce, unlike fiat currencies that can be printed endlessly at will. It's also borderless. I mean, you can send Bitcoin to anyone in the world, anytime, anywhere, without needing a bank, a middleman, or even permission. All you need is their wallet address and some Bitcoin to send, and the network does the rest once you submit that transaction. And most importantly, Bitcoin offers something fiat never can: resistance to inflation. And here is how that works, and I'm going to use my favorite example to explain inflation and how Bitcoin's finite supply is its best quality. Now, I want you to imagine a world with 10 people and 10 homes, and each person starts with $10 in their hands. So the amount of money in this total economy, in this hypothetical world we've created, is 10 people times $10, which is $100 in total. So every person can now go out and afford one home because their buying power is the exact same, and homes will cost around $10 each. This is a perfectly balanced system where everyone can afford a home and prices are stable. But now let's change one thing. Imagine the government decides to stimulate the economy by handing out an extra $100, but only 5 out of the 10 people qualify for this stimulus. Here's how things would look now. 5 people would still have their original $10, but it's secured in the real estate in which they have purchased. They have no cash on hand, in other words. 5 others now have $30 each with $20 cash in hand and $10 secured in real estate. Now, the total money in the system is $200, as we've added the printed $100 to the original $100 that was created. But the number of homes, it's still just 10. Now what happens? Well, the people who received extra cash have no buying power beyond their home, but The people with more cash have more options. They can start bidding higher to secure better homes or buy out the others. Sellers begin to realize there's no more money floating around, so they raise their prices in order to build a bit of cash up. Suddenly, homes don't cost $10 anymore, now they cost $20. The new reality is 5 wealthier individuals can still afford a home as they have $30 each and can spend their $20 in cash on a new house, keeping their original $10 invested in their first home. And the 5 others, despite owning a $10 home, are priced out of buying another unless they sell their original home. So what do? Well, in order to access more cash, these 5 buyers who didn't receive the stimulus package start selling to access cash. They receive $20 for their $10 home, 100% return on their original investment. Sounds good, right? But here's the catch. If the government prints another $100 in the next year and gives it to the same group who are able to access the stimulus, prices will rise again. Now, homes might cost $30 or $40, and that $20 in cash they just received, it's no longer enough to buy a home. That's how inflation works. When the money supply increases faster than the goods, prices rise, and the purchasing power of your money drops, even if the number in your bank account stays the same. Now, this little example isn't just a thought experiment. This happens every single day in the real world. When governments print money, issue stimulus, or expand the money supply through loans, through credit, or bailouts, they're injecting more dollars into the system. But here's the problem. If the number of goods and services in the economy doesn't increase at the same pace, you get inflation. Too much money chasing too few things. It's like being in a crowded auction where more people keep showing up with blank checks. The prices of everything starts to spiral up. Suddenly, that $5 coffee becomes $7. Rents tick up another few $100s and your grocery bills jump. But your paycheck, it stays the same and it can purchase less. Now, here's the beauty of Bitcoin and why it flips the script. Bitcoin has a fixed supply, like we said before. Just 21 million coins will ever exist. Not 22 million, not 210 million, 21 million. It's hard-coded into its DNA and cannot be changed. Not a president can change it. Not even a central bank can change this factor, and not even the creator of Bitcoin. This is why Bitcoin is immune to inflation by design. No matter how chaotic the world gets or how much fiat is printed, Bitcoin's supply stays the same. So what happens when demand rises? Well, the answer is simple. With the limited supply and growing demand, the value of each coin grows. Just like our hypothetical example before, when we keep the number of homes the same but keep printing money, by natural demand, the prices of those homes increase on their own. And Bitcoin's the exact same in the real world economy. As we keep printing fiat, but we can't increase what we are purchasing with it, the price and demand of that is going to naturally increase, and it's going to take more value in order to secure a Bitcoin due to its limited supply. And this is why Bitcoin is an investment and form of money that gets stronger with time and stronger as inflation increases. And for years, Bitcoin was dismissed as a fringe, something that only internet geeks or libertarians or black market users cared about. It was called a bubble, it was called a scam, a Ponzi scheme, or just a phase. But today, the narrative has shifted completely. Major institutions, the same ones that once doubted it, are now stepping in to secure it. BlackRock, the largest asset manager in the world, has filed for Bitcoin ETFs and is currently helping their customers attain it. Fidelity is offering Bitcoin to retirement clients. JP Morgan once openly was so critical of crypto and now is building blockchain-based systems behind the scenes. And this is exactly what they don't want you to know. They don't want you to know that they are accumulating this asset in the background. I mean, Bitcoin ETFs are being approved left, right, and center, giving traditional investors easy access into the market through regulated stock markets. And it's something that we have never seen in the crypto market before. And it's not just companies. I mean, entire countries like El Salvador have adopted Bitcoin as a legal tender, integrating it into their national financial infrastructure and system. And the mainstream isn't arriving because of hype. They're coming in because they see cracks in the traditional financial system. Unsustainable debt, endless money printing, fragile trust, they're all looking for alternatives that actually solve this problem. And Bitcoin, once ridiculed, is now being recognized for what it truly is, a foundational shift in how money, value, and trust can operate in a digital age. Now, here's the opportunity we have today. Think back to the early days of the internet. I want you to go back in time in your mind and think about the 1990s. I mean, most people didn't get it. They thought the internet was a passing trend, something for tech nerds, not something that would ever affect their daily lives. I mean, even major mainstream newspapers back then dismissed it as novelty. But a few people looked deeper. They saw the potential and they built websites, they launched businesses and invested in internet infrastructure. And those early adopters didn't just change their lives, they helped build the digital world we know and live in today. Amazon, Google, Facebook, they were once tiny, obscure startups built during a time of doubt, and no one was backing them. I mean, now we're in a similar point with crypto. Bitcoin and blockchain technology are doing for money what the internet did for information, breaking it free from centralized control and making it borderless, programmable, permissionless, and completely transparent. And this isn't just a trend, it's a complete shift in rethinking of how value, trust, and ownership can work in the digital age. One that can be controlled by the people themselves, and one that cannot be controlled by any central authority. And just like with the early days of the internet, the people who take the time to understand why this technology matters, not just what it does, will be the ones that benefit the most to the outcome. If you found this helpful, please subscribe. This is Token Integrity. We are here to bring the truth about the market, and we're going to be exposing so much in our future. I'm looking really excited to working with you all. I hope you have an excellent day.